Welcome everyone to our Mortgage Refinance virtual seminar. I'm Carrie Endress, Vice President of Marketing at Newmark Credit Union and your host for today. Thank you for joining us. All attendees are now in a listen-only mode and all lines are muted. Please use the question box on the side panel to ask questions. All questions will be answered at the end of the presentation. We will want to hear from you, so watch for polling questions to appear in this panel. You can also raise your hand by clicking on the hand button in the icon boxes. After the seminar, we will send you an email with handouts and a survey. At the end of today's presentation, please take a few minutes to complete the survey to help us prepare for future seminars. Now let's get started. I'd like to introduce to you Newmark Credit Union's Vice President of Mortgage Lending, Harry Stewart. Harry began his career in the mortgage industry in 1996 and has been with Newmark Credit Union since 2010. He has gained experience in structuring all types of loans: FHA, VA, conventional, conforming, jumbo, reverse, and commercial loans. His favorite thing about working for Newmark is helping people realize their dreams of owning a home. Harry grew up in Chicago and resides in the suburbs. He loves spending time with his wife and children. Join me in welcoming Harry Stewart.
Hi everyone, my name is Harry Stewart with Newmark Credit Union. I'm the VP of Mortgage Lending over here. This is our first attempt at a virtual seminar, so I'm so glad that you could join us. We're going to talk about refinancing: when, why, how, and I hope you gain a lot of knowledge from this webinar. So let's get started. So what is refinancing? Refinancing is basically paying off your existing loan commitments and starting over a brand new commitment. Why would people really want to refinance? There's several different reasons people would want to refinance it. It basically comes down to benefit, like what benefits the individual looking to refinance. If rates are lower, that's kind of market driven. So when rates are lower, you have a chance to save some money. You could also reduce your term. I see a lot of people going from like a 30-year mortgage down to a 20-year mortgage or a 15-year mortgage. And what that does, that just allows you to build equity a little bit faster. Or if you need cash out for any number of reasons, that could be paying off high interest rate credit card debts, could be paying off auto loans, it could be to pay college tuition, large purchases. Home improvements is very popular. It's very expensive to redo kitchens or bathrooms, so a lot of people take out cash for that. It could be investment properties. I've seen people take out cash for investment properties. But my general rule for refinancing, if you're going to do a rate and term refinance, your general rule is going to be you want to lower your interest rate by at least 1% and recover your closing costs within an 18-month period. So just to give you an example, if our closing costs, I'm just going to throw out a generic figure, is $1,500, and your refinance is saving you $100 per month, you are going to start realizing your benefits after 15 months, because if it's $100 a month that you're saving, after 15 months, that's when you're going to start breaking even with the cost that you spent, closing costs. So that would fall within that 18-month term or 18-month period that I kind of use as a general rule when talking about refinancing. Now, it's not a rule that's set in stone. Sometimes you can drop your rate by 0.5% and recover your closing costs in 11 months or 22 months. So it's not a set in stone, but that's just a general rule that I like to throw out. So let me ask everyone a quick question. Which choice best describes your current interest rate? So we kind of touched on this a little bit already. Why are people going to refinance? I would talk a lot of debt consolidation, lower rate, typically translates to a lower payment. Not always, or not not always dependent. Well, I guess we could get into that later, but usually a lower rate's going to equal a lower payment, but not always. Cash needs for any type of large purchases, boats, campers, any type of home remodeling, additions, adding a garage, long-term investment plans. I know a lot of people take cash out to purchase second homes, vacation homes, investment properties. Why would someone want to refinance? I'll give you a little bit of time to answer. But the choices are to free up some extra cash, to buy a new home, to take advantage of the lower rates and the current market rates, or to remove private mortgage insurance. I'll give you a little bit of time. So how are we going to refinance? See, the easiest part, the easiest thing to do is set up an appointment with a mortgage officer if you're unfamiliar with the refinance process. Or you could always complete an online application at our website, www.newmarkcu.org. If you go to mortgage loans and apply, there's a brief 10-minute application. It's very simple to fill out. Once you fill that out, the loan application will be signed to one of our senior loan officers, and they'll be in contact with you to work up, go over the best options for you. Items needed for application. Now this list is kind of a generic list, so it might not pertain to everyone, but these are things that we're going to need on most loans. 30 days worth of paycheck stubs, the last 2 years of W-2s, the last 2 years of tax returns with all schedules, bank statements, the last 2 months of bank statements, homeowners insurance for at least the property that we're doing. But if you have multiple properties, we would want to see the homeowners insurance for all the properties. Copies of mortgage statements. If you have a second mortgage or a home equity loan, we'd want to see a copy of that too. And if you have additional properties besides the property that we're refinancing, I would need those mortgage statements from those properties as well. And just a recent one. It doesn't have to be one that's this current month, but it could, as long as it's within the last 2 or 3 months, that should be fine. Flood insurance. If you're in a flood zone and you have flood insurance, we need a copy of that. If you have recently been through a divorce, we need a copy of your divorce decree. Or bankruptcy within the last 7 years, we would need copies of your bankruptcy papers, discharge papers, and list of creditors. If you're self-employed, we're going to need copies of the last 2 years of your business tax returns. So depending on what type of business you are and how you're, or if you're incorporated as a corporation, S corp, or sole proprietorship, that would kind of dictate what business tax returns we would need. But yeah, the last 2 years of business tax returns, fine. If you're retired, Social Security awards letters, I would need the most current one. Recent pension statements or 1099s from your pension, and any explanations for any type of derogatory items that show up on your credit, I would need an explanation on that. And that's really about it for the application. And if there's anything specific that I might need for that's not on this list, after our appointment, I'm gonna tell you exactly what I'm gonna need. And if things come up during the process, we could always chase that stuff down later. So now it's time to just go over the different loan options. So once I get your application and I work it up, I'm going to run credit. I'm going to look at your income. The only real wild card is really going to be the appraisal at that time. But I'll go over some different options with you, and we'll kind of narrow down what your monthly payment's going to be with the different options, what the options are with cash out versus without the cash out. So once we narrow down what you're kind of headed towards, and you could always change your mind halfway through the process, like, hey, I want escrows, or I don't want escrows, or I want cash out, or I don't want cash out. Now it might affect the rate or the cost by making those changes. However, you're able to change your loan around as long as it works. You're able to change that loan amount around up until closing. So just let me know if you change your mind on something. So I was talking. I look at the credit, the capacity, and the collateral. The credit portion, I'm going to know right away, right when we sit down, or right when I bring in your application. I'm going to run your credit within about 5 minutes of looking at your application. So I'm going to know what your credit profile looks like almost immediately. Capacity, all capacity is your ability to repay your debt, your income versus your expenses, and it basically is it's just an analysis of your ability to repay the new loan that we're giving you, plus your other debts. And the collateral portion that we were talking about is just your appraised value, or the equity in your home. So that's really going to be the only wild card, because we're really not going to know what your appraised value is until we get an appraisal. There's ways to kind of do our homework beforehand and just see what the value is going to be, but we're not really going to be 100% certain of what your value is until we get the appraisal. On a side note, a lot of refinances nowadays, we're getting a waiver where we don't need an appraisal. So that basically the automated underwriting engines that we use will tell us, hey, you need an appraisal on this one, or you don't need an appraisal. You're going to get a waiver, so we don't even have to order an appraisal on your property. So if we get one of those waivers and we don't need to order an appraisal, it kind of speeds up the process. And basically what they're saying is, hey, we believe your value to be accurate. So if I plug in a value of $250,000 and Fannie Mae or Freddie Mac says that that's what around what that value is going to be, they're going to give us a thumbs up and say, hey, you don't need any type of appraisal on this to do the loan the way we have it right now. So that's good news. It saves you money, and it speeds up the process, makes things a little bit easier, and it kind of removes a little bit the headaches of cleaning your house and scheduling time for the appraiser to come out there. We're also going to complete the application, the disclosures. There's probably about 33 documents at application and disclosures that you have to sign and acknowledge. So if we do it electronically, because we do allow e-signing, you could always go in there and e-sign everything, and that's typically what most of our members tend to do. I'd say about 60% of them are going to be e-signing, but if we do meet in person, I would have you wet sign the application, the intent to proceed, and all the other disclosures. at the same time I'm scanning your documents into our system. We'd go over any type of out-of-pocket expenses. Typically what I'll do, I'll back into a loan amount during the process. So if if we have a loan amount and for some reason your payoff comes in a little bit higher, or you owe real estate taxes towards the end, or if there's something else that you had to pay for that we didn't know about, possibly a judgment or a lien, or maybe a balance on a HELOC that we need to take care of, we normally can adjust that loan amount and cover that as long as we have equity in the property. So makes it we're kind of flexible with that stuff. Just let us know before closing. Like after closing, it's tough to change anything. But prior to closing, there's pretty much almost nothing you can't change as far as the loan goes. And obviously the appraisal, we tend to run a lot of specials where we're going to cover the cost of the appraisal for our member base. You'd have to pay for it up front, but we're basically going to reimburse you for that at the closing. So I wanted to talk a little bit about when everything isn't okay with the loan process, because everything won't always work the way we want it to. Um, I'd say the biggest thing is probably going to be when the appraised value. On the ones where we need an appraisal, if the appraisal does come back a little bit lower, at that time we have to reevaluate the loan. It might mean lowering the loan amount. It might not affect anything. But if where different ratios and loan to values are right on an edge, it may affect the loan. And at that point, we'd have a discussion with you to see what direction that you want to go and go over the different options. Property condition, if there's something negatively wrong with the property, maybe a crack in the foundation, flooding, maybe a leak in the roof, something like that would definitely need to be corrected prior to us closing. I don't know how, if it's something small like a hole in the drywall or something, or maybe a door that's broken on a cabinet or something like that. It's not going to affect it too much, but some of the major stuff, anything that would affect the safety, the soundness, or the stability of the property would definitely be of concern. Any type of surprises on the credit report that would show up. If we updated the credit report prior to closing and we found that you just purchased a new car or another house, that could definitely cause issues. One of the 3 C's was capacity. So adding another large debt like a car or a mortgage would definitely affect that. So it's possible that it wouldn't necessarily kill our chances at refinancing, but it would definitely be looked at, and it could possibly, if your debt ratio is on the cusp of approval versus not being approved, something like that could negatively affect the loan. Any type of judgments that show up on title, any liens, any second mortgages that were undisclosed, any type of tax liens or back owed taxes on the property would negatively affect the loan process. Any type of job loss, any pay change, if you lost your job or if you switched jobs mid-process, that could affect the loan. Same thing with a pay change. If you make more and it's just strict salary, it might cause a delay, but it shouldn't affect anything negatively. But if your pay was reduced for whatever reason, or if you're used to making salary income and you jump over into a commission-based income, that can negatively affect the loan process also. So once the best rule is like once you start the refinance purchase, and this would go for any type of mortgage. Once you start that process, you don't want to change the snapshot of your credit profile. You want to keep everything exactly the same until after closing, and then that's when you want to buy your other house or your other car, or switch jobs. Now, if it's absolutely necessary that you do any of those things, switch jobs, take a different um, job within the same company or buy a house, if you have to do something like that prior to closing, let your loan officer know, just so they can work the numbers prior to you doing that and letting you know how it will affect the loan. Any type of undisclosed child support or alimony that shows up later, that could negatively affect the loan. So typically, some of that stuff will show up on paycheck stubs, but they don't always just it doesn't stick out. You know, they don't say alimony or child support. Sometimes it'll be coded. So if that stuff comes up at the end, that could negatively affect your debt ratios. So we touched on this a little bit, but changes during the loan process, we we typically back into a loan amount depending on what our members want. So if we order a payoff and the payoff comes in a little bit higher, you know, and we've got room, I'll typically before closing I'll call and discuss with the member, hey, do you want to increase your loan amount or do you want to bring in the difference at closing? And little calls like that save a lot of headaches later. So a lot of people don't want to bring in any money at closing, and some people don't want to increase their loan amount. So having that conversation up front goes a long way. Different programs. Sometimes I've got members that are torn on like, do I want a 15-year? Do I want a 20-year? Do I want a 30-year? So they bounce that back and forth. Do I want escrows? Do I not want escrows? Do I want to just pay one but not the other? So a lot of these guys are having discussions with their significant others at home, and they'll decide on something else. That they might start the loan as a 15-year with no cash out, and then they might change to a 30-year with cash out by the time it's done. So all these changes, we can change stuff prior to closing as long as the loan continues to work. Um, if it doesn't work, you know, I'll still go over different options or go over that stuff with you. But for the most part, we can change these loans up until closing. Even a payoff like mentioned or that's on this slide. Sometimes payoffs come in higher, sometimes they come back lower. So that could change the loan structure too. So I'll talk about the role of the mortgage officers and our team here. Uh, Basically, our job is going to be to take your application, gather all of your documents. We're going to order appraisal. We're going to order the title. We're going to verify your payoffs, verify your employment. We're going to change your insurance around so the mortgagee reflects your new lender. Basically, we're going to dot I's, cross T's, and update you on the status along the way. I would say the biggest parts in the process, if we start out and we gather all of our disclosures, all of our documents up front, um, I would say the big parts in the process are going to be when we receive the appraisal and when we receive the title. So that's really going to be the big parts of the process. The appraisal is that one wild card that I said we're not really going to know until we get it. And in the case of if we get a waiver, then we don't need that appraisal. So the big part's just going to be getting the title and the payoffs on something like that. But it it moves a lot faster without the appraisal, because these appraisals, since the rates are so low right now, they're super busy. Some of the turn times on with some of these appraisers is going 3 weeks, 4 weeks sometimes to get an appraisal back. So definitely speeds up the process when we don't have to wait for that. So once we get everything together, we're going to gather uh, all your documents. We're going to dot all our I's, cross all our T's, verify employment, verify no changes to credit. We're going to get updated copies of your bank statements, updated pay stubs. We're gonna grab all that stuff, and once we're ready, we're gonna give you a call and just schedule a time for closing. Now, our title company reps are very flexible. We can close in any number of our branches. We can also close right in your home. In fact, we've actually closed at a Denny's at 11 o'clock at night, just to work around our members' schedules. So whatever is convenient for you, we'll find a way to make that closing happen for you. Um, I will say there's a lot of documents. There's probably about 90 documents that you sign at closing. The title reps are all professional. If you need any type of funds, um, here it says cashier's check, but that's for amounts over 5,000. You could write a personal check for anything under 5,000. And in Illinois, well, primary residence is anywhere. You have your 3-day right to rescission. So your loan really doesn't fund until 3 days pass after closing. And so the way the loans are going to fund, the title company is going to wire that money right when it funds. We send the money to the title company. They're wiring that money off to pay off your old mortgage, any second mortgage or HELOC that's being paid off, any type of taxes. They're sending that money out immediately. Any checks to creditors or credit cards or anything that you're paying off in the loan would also disperse, and the checks would get sent out the same way. Credit union members do have an advantage. We're not going to have the title company send out that check, any cash out to you. We're going to deposit it directly in your Newmark account, so that kind of saves time. Okay, I have one more poll question for you before we wrap everything up, and I'd just like to ask you, what would you do with the extra $4,000 a year? Now, it's kind of a question that's thrown out there. Is it going to be extra $4,000 for everybody? Maybe not, but in some cases, it's a lot more than that. Sometimes I'm saving somebody $10,000, $12,000 a year. So I'm just using 4,000 as a generic figure. And do you know anybody that's used mortgage savings to go on vacation or pay some of their college tuition or make different types of home improvements? And that's kind of what I'm looking for. So now it's time to wrap up everything. When are most payments going to be due? So let's give an example. The mortgage payments are always going to be due on the first of the month. A lot of people say, "Oh, I pay on the 10th or I pay on the 15th." Yeah, but technically, if you look at your mortgage note, it's going to be due on the first. They're just giving you that 15-day grace period to make your payment. So all of our mortgages have a due date due on the first. You'll have a grace period, 15 days to make that payment. And typically, it's not the following month that you would have to make that payment. It would be the month after that. So let's say we close today. Your first payment wouldn't be due October 1st. It would actually be due November 1st. So everybody says you get to skip a payment. It's not 100% accurate because you're paying that prepaid interest prior or at closing. So it's not really getting to skip a month. It's just included with your closing costs. You've already paid for that interest. And yeah, there's several different payment options. We've got automatic or ACH payments. We have bi-weekly payment options. You could always come into the branch to make a payment. You could always mail off a check the old-fashioned way. So several different payment options, and then I guess it's time to relax. Any questions?
Hi everyone. Thanks for joining us. This was actually our very first attempt. I've been doing mortgages since 1996, and this is the very first webinar I've ever had to host in all that time. So I hope you enjoyed it. You learned a lot, and we're getting into our question and answer phase here. I would say I've done hundreds of radio shows, hundreds of cable shows, lots of live seminars, but this is, I will have to say, this is the very first virtual seminar I've ever done, and it actually made me pretty nervous, more nervous than if I had a room full of 50 people. So let's get into some of these questions. Matt had a question. It says, what does cash out mean? Cash out, it's just anything above and beyond the actual mortgage payoff. So if you're looking for cash out for any number of the reasons that we mentioned earlier in the webinar, that would be considered a cash out loan. And typically there's a premium, sometimes depending on credit score and loan to value. It could be an eighth higher in rate. Sometimes it could be a 0.5% higher in rate when you switch to a cash out. Also, consolidating credit cards or paying off something would also be considered a cash out loan. Let's see here. Got some additional questions. Let's do. How long does it usually take to refinance a mortgage? I would say typically our claim to fame was like 3 to 4 weeks when we weren't busy, but the rates right now are the lowest they've ever been in history. When I got in the industry back in the 90s, we're doing loans at like 8 or 9%, and I remember when they dropped to, it was like 7.375, and I was thinking to myself, and I'm sure I was telling people at that time, the rates will never be this low again, 7.375. But now we have 30-year fixes into the mid to low twos. Some of the 15-year products are flirting right in the low twos, kind of threatening the high ones. So who knows, it might happen. But yeah, they've never been this low. So what that causes is everybody's refinancing at once with these low rates. So it definitely definitely slows down the process a little bit when everybody's doing it at once. So I would say a good time period would be maybe 6 to 8 weeks for a refinance. More, maybe 5-6 weeks if we don't need an appraisal. If we need an appraisal, a subordination, maybe some other items to clear up, might be closer to that 6 to 8 weeks. So I have a question. How will the appraised value on my home affect my ability to refinance? That's probably the one wild card that we're not really going to know. We're not going to know what your actual appraised value is. So on the loans where we do need an appraisal, I don't. If we do need an appraisal and we don't get a waiver, we're not really going to know that until that appraisal comes back. We could do our research on Zillow and the websites, and I'm usually pretty good about that because I'm going to think like an appraiser. I'm going to go right to Zillow and look for similar sales within the last 12 months, and I'm going to try to get a good value based on those. Like yours might have a finished basement. Maybe the one that's sold next to you doesn't have a finished basement. So I'm going to kind of make an adjustment from there. But that's kind of how I would back into an estimated appraised value without actually having an appraisal. But right now, we're getting so many appraisal waivers that in some cases, especially the rate and term refinances where we're not looking for cash out, it sometimes we don't even need appraisals. So let's see, let's do. Bear with me here. So what is this one? Leah is asking, what is the process to pay? I'm thinking that that's like a principal reduction. You could, none of our loans have prepayment penalties attached to them, so you could apply as much as you want towards the principal. Every mortgage payment has a certain amount going towards principal and a certain amount going towards interest. After that regular payment, you could decide to make additional payments to principal to pay it off earlier. Sometimes, and I know everybody's heard of biweekly payments. Basically what that does, that equates to one extra payment of principal to the mortgage payment over the course of the year, because it's a payment every 2 weeks. So that reduces your principal and essentially turns a 30-year mortgage into a 23-year mortgage. Does it have to be set up that way? No, you can wait till you get your tax return and just make that extra payment every year to the principal, and it'll basically do the same thing. And that was the next question, the biweekly. I didn't even see that question. I went into the biweekly, so that's good. Let me see here. Let's see some other one. I didn't really touch on it too much in the webinar, but a lot of people will refinance to drop out of the PMI. Since 2013, the FHA mortgages have the PMI doesn't fall off; it's on there forever. So if you are in an FHA mortgage and you got your mortgage after 2013, your mortgage insurance will stay on that loan forever until you refinance. And FHA mortgage insurance is kind of expensive. So if you think your equity's there and your credit's improved since the time you did get that FHA mortgage, you might want to consider refinancing and dropping that PMI, because if we could drop your rate and take off the PMI, that's like a win-win and could result in savings of a few $100 a month. So that's always a plus, unless you like spending extra money. He said that's not that great, right? Okay, let's see. Okay, so average closing costs, that's another question. I'm kind of reading the questions off of, I do a radio show every month on WJOL with Scott Slocum. It's a Money Talk Radio in the morning, and he has some good questions. So I'm kind of going through a list here and see which ones that I didn't touch on yet. Closing costs expected to pay. I would say the average refinance is anywhere from $1,500 to $2,000, but I always like to talk about closing costs as like almost like a scale, with rate being on one side of the scale and closing costs being on the other. So if your rate's going down, you could pay more in closing costs with I know you guys have heard the term points. So let's say the rate's coming down and points are going up, or closing costs. That's one way to look at it, but also look at it as the rate going up and maybe no points, and then rate going even a little bit higher to get like lender credit to cover things like recording fees or title fees or any other closing costs that are involved in the appraisal. So I like to look at it as a scale, and there's not a way we can't structure the loan. So in some cases, maybe we run out of room on an appraisal and you don't have money to bring to closing. So in that case, I'd discuss the option of a higher rate with a lender credit to cover those costs. Or in other cases, just our standard no point refinance, and we would roll in your closing costs, assuming there's equity. If we're really close to, like, if we're right around maybe 18% equity and you don't want to pay mortgage insurance, we can work around stuff right there. Maybe a higher rate lender credit, so you don't have to bring in or so you don't have to bring in money at closing, but you could still avoid that mortgage insurance. I would say personally, I don't like discount points. So I do have people looking to buy down the rate, but personally I don't like discount points. I'll tell you a little bit why. If back, I want to say it was right around 2007, I had a client that he bought down his 15-year mortgage, like 3.5 points, and it was a big loan amount too. So it equated to almost $16,000 that he wanted to buy down his rate to get a 4.5% rate on a 15-year, because at that time he was under the impression that the rates, it's a gamble. So he was under the impression that the rates would never fall lower than they were at that time, and that was a 4.5% on a 15-year. So if we fast forward right to 2020, where we're at right now, the rate on a 15-year mortgage, we're doing stuff in the low twos. I quoted somebody at 2% on a 10-year just recently. So that's a 2.5 point swing from what we paid for 4.5% back then. So he paid all that money up front, and the rates have continued to drop since that time. So he wouldn't even be able to really refinance for 10 years since getting that mortgage. He could, but he'd lose out on what he already paid. He's basically prepaying interest. So that's kind of why I'm against discount points, because you never know what's going to happen. And whatever you do, if you pay points, or it's kind of a gamble, because you're betting that the rates will never be lower than what you're getting. And we know the rates can move one to two ways. They could either go up or go down. So it's a 50-50 gamble. And with finances, I don't really like doing that. Let's look at some of these other ones here. Let's see here. You know what? I don't see any other questions here. I guess the one question Scott always asks towards the end, he basically asks, well, what's the best way to reach you if we're looking to refinance? The best way to reach us is through email. If you're looking to complete an application, you could always go to our website, www.newmarkcu.org, go to mortgage loans, and then apply. It's a brief 10-minute application. As soon as you hit submit, I get notified, and I assign those loans out to our senior loan officers, and we work them up and get back to you within 24 hours. It's a pretty simple process with us, but there is some delays, but there's delays everywhere, even with our investors. So I would say maybe 6 to 8 weeks from start to finish. And yeah, I don't see any more questions. So at this time, I'd like to thank everybody for joining us, and hopefully you got something out of it. Like I said, usually I'm used to a lot of interaction with live seminars, but I enjoyed doing this as my first webinar. So Have a great rest of your day, and hope to talk to you guys soon.